So, right, there are a lot of different types of shares. The most popular ones, the ones that are main. Okay, sorry. The most popular ones, the ones that are mainly traded on the stock exchanges, are ordinary shares. They give you the right to elect the board of directors, i.e., CEO, vote on proposed compensation of the CEO, vote on the dividend level to be paid out, and etc. However, owning a company means you have a limited liability, and in case of a bankruptcy, ordinary shareholders are standing last in the line to receive compensation if there is anything left after all creditors are paid. Also, there are non-voting ordinary shares, which, as the name suggests, does not have voting rights with them. Hence, if company have issues, sorry, if company have issued both types of shares, non-voting class should be traded at a discount compared to the ordinary shares. Um, I didn't list all types of shares because there are numerous types. Some are tailor-made to meet the investor demand, but here you see the major types that are most commonly traded in the financial world. Probably the most basic theory in finance is the time value of money, often expressed as the present value or future value. The time value of money is a concept where today's cash flow is converted into an equivalent value to any point in the future using interest rates. What it tells you that £1 today is worth more than £1 tomorrow. For example, if I can buy a can of Coke today for £1, and because of the inflation, after 6 months, the same can of Coke costs £1 10 pence, it means that I value £1 today more than I will in near future. Hence, when banks lend money, they charge you interest rates to be compensated for the loss of the value and, of course, to earn money themselves. Here's an example of the time value of money. Again, we will upload these slides on our website, so where you can investigate them further at your own convenience. There is a standard formula to calculate present value or future value of an investment, which is the cornerstone in understanding the time value of money. We talked about inflation last week in economic environment session. Today we'll see its relationship with investments. Say you earn 5% on your investment in 1 year, but the inflation rate was 3%. Therefore, your real return is not 5%, but 2% because of the inflation eroded your purchasing power by 3%. By subtracting the inflation from the return, we only get an approximation where professionals and academics calculate real rate of return by using this formula, which gives you a more accurate result. All investments carries a risk, whether it is a risk of company going under or debtors defaulting or their debt. You can't eliminate risk entirely. However, some types of investment carry high risk and some are low risk investments. Hence, the potential return varies on the level of risk. High risk, potential high reward. Low risk, potentially low reward. But you can never be sure that when investing in a high risk investments, you will always get a high reward. That's why it's called a high risk. We can continue recording. I'm sorry about that, guys. Right, where are we? So, right, Right, so the high quality bonds such as US Treasury bonds, UK gilts, or Germany bonds are usually seen as virtually risk-free because government can always print more money to pay off its debts. However, there are a few examples where governments have defaulted on their debt. For example, Argentina. If you are familiar with this case with Argentina, they have defaulted, I think, 6 times on their debts. So risk and return applies to everyone, even when you apply for a mortgage. Say a person who has a bad credit score applies for a mortgage. He's very unlikely to get as good deal as a person with a good credit score in terms of interest rate for a mortgage. And by the way, you can always negotiate with the bank to get a better interest rates. A lot of people don't understand that, but when you're applying for a mortgage, put yourself through and try to negotiate as low interests as you can. And continuing, so for a bond market, there are professional companies who evaluate risk of governments and certain companies. 3 major credit rating providers are Moody's, S&P, and Fitch Ratings. We'll talk more about risk and their types. There are a lot of them, and some of them can be avoided, some of them cannot be avoided, and it is always necessary to take some risk to get some kind of reward. Even the safest assets we just talked about carry some degree of risk. For example, interest rate risk, that is, if you buy a gilt with fixed coupon of say 3% per annum, and Bank of England unexpectedly announces interest rate increase, and hence now the very same gilt offers 5% return per annum as compared to the one that you are holding with only 3%. When investors invest in companies, they are subject to numerous risks. And most obvious is that a company can perform poorly and the value of their investment might go down. To protect themselves from such capital loss, investors usually spread their investments through a range of companies, usually from different industries. So when one industry performs badly and hence all companies in that industry suffer, other firms from different industries might be doing very well, thus offsetting the fall. Of course, some risks cannot be avoided. There are systemic and systematic risks. Systemic risk relates to the whole financial market, and one example is 2008-2009 crisis, when the collapse of the mortgage-backed securities took down the entire financial system. Systematic risk is often called the market risk that affects the whole market and cannot be mitigated. For example, liquidity might become an issue when there is a collapse in the prices of securities, and because there is no liquidity, you cannot sell your investment, and thus you just observe the value of your investment going down. We have talked about the inflation risk, and also there is a current risk. For example, you invest in a UK-based company who sells its goods overseas, and if the pound gets stronger, it threatens the position of the company as a supplier. If the pound gets stronger, that means you need more of the other currencies, say euro, to buy the same amount of goods as before. Hence, if pound becomes very strong in relation to euro, firms might start looking for other suppliers, and thus this UK company starts losing its customers and its profits are hurt. And sorry, I was referring to currency risk. I said current. Right, and again, capital risk is embedded in the performance of the company, or sometimes systematic risk factor. In the investment process, age of the investor plays a crucial role in determining a level of risk he or she can take. For example, younger investors who still have whole life ahead of them can take on more risk and thus invest heavily in equities, i.e. shares, whereas older investors who need to think about their pensions might want to take less risk and invest more heavily in bonds. Here we have income risk, which stems from debtors defaulting on their debt or companies seeing a fall in their profits and their profits cease to pay dividends. An example would be a British Petroleum. Probably everyone at least heard about 2010 Deepwater Horizon oil spill. Prior to the spill, BP had increased its payout 15 out of 17 years and it had maintained a dividend. However, the company made its final payment on 8th of March 2010 of 84 cents per share and would not make another until 28th of March 2011 when it paid out 42 cents per share. Usually bonds and bank deposits have minimal income risk, but you should be aware of the inflation effects that could erode your income. Issuer risk is related to income risk in the sense that a company may perform poorly during a given period and default on their debt or stop paying dividends. But there are other more issue-specific risk factors, such as illegal activities or financial crime, what can severely affect the company's reputation and stability. Another type of risk that you should be aware of is non-systematic or specific risk. The name suggests that because of being specific risk, it might be mitigated, and it is done by diversification, i.e. the famous saying, don't put all your eggs in one basket. We'll talk about these non-systematic risks in more detail in the following slides. One of the best examples during these times could be illustrated as follows. Say you have bought Fulham Shaw PLC and Amazon stock in 2019 December, and because of the lockdown, restaurant industry have suffered greatly, but online retailers on the other hand, and specifically Amazon, risen enormously. Thus, by this time, your losses at Fulham Shaw PLC would be offset by the gains in Amazon stock. But this is not recommended, i.e. holding only two stocks, as you might lose by not holding stocks in sectors that see huge gains. Usually, to fully diversify non-systematic risks, it is recommended to hold 15 to 20 stocks. By the way, this is not my recommendation, but I'm talking from the book, from the general examples, and from academic papers that the usual suggestion is to hold between 15 and 20 stocks, and this is not my personal recommendation. Also, you should take into account the advantage of diversifying by market, not for the challenge though. It has an advantage to mitigate such risks such as Brexit by including United States stocks in your portfolio, or by minimizing trade war risk between China and the US by investing in developing economies. For the most part, general suggestion is that invest in funds, ETF for example, where diversification is already done for you. Your portfolio should not be constrained by only investing in stocks. You can and should include other asset classes such as bonds and most definitely cash in case of emergency, that is mitigating liquidity risk or a great opportunity to participate in IPOs. Now we will shift focus to calculations and analysis of the portfolio. Here is the formula to calculate your return on given holding period, hence a holding period return. Again, these slides will be uploaded on our website where you can investigate these formulas at your own convenience, and you can ask questions about the formulas if you don't understand something. We'll try to help you to learn. When you go, Most famous risk measure in financial world is standard deviation, and it is simply a square root of the variance. It tells you how much returns have deviated from the average over a given time period. However, please be advised that past data is not an indication of the future, rather a glimpse of what was happening until a given point in time. Following probability distribution, i.e. bell-shaped curve, there is a 66% chance that the given stocks will vary by 2 standard deviations from the mean, either in positive or negative direction, and 33% chance, 99% chance that it will go even further than 2 standard deviations, that it might deviate at that bigger range. Here's the formula to calculate variance and thus standard deviation. Don't worry if you don't understand it, as in the next slide I will go in more detail. And at the end of the session, I will present Excel formulas to calculate variance and standard deviation. Here's the example, and you can see that there is data from past 3 months. First thing you do is calculate the average, pronounced mu, and according to the formula, you subtract the average from the actual result, square it, and sum them up. Please take a note about the denominator. Here you see a fictional example where there are only 3 months of data, and it is assumed that this is all the available data, and in statistics it's called population. Whereas in real life, you take a sample, say 5 years of monthly returns from a company that has been public for 20 years. And because it is only a sample, you have to divide sum of square deviations by n-1 to take into account that it is only a sample. And then simply take the square root of the result to get the standard deviation. Another important metric in financial world is correlation, which tells you how to 1 and +1. -1 being perfectly negative, that is, they move in opposite directions. For example, if a stock A gains 10%, then stock B will fall 10%. The same goes with positive correlation. If stock A gains 10%, then stock B will gain 10% as well. But the correlation has to be 1, equal to 1. And correlation of 0 indicates that 2 securities do not correlate with each other and don't follow any pattern between each other. Covariance takes higher values than -1 and 1, but it does not tell you the full story between the securities, and it is needed to calculate correlation, as you can see in the bottom. You can rearrange the formula to get correlation, which equals covariance divided by the product of standard deviations of the assets you're calculating. Don't worry, we'll take a closer look. One key takeaway here is that a security with a high standard deviation in isolation does not necessarily have a high covariance with other securities. So to calculate covariance, you will need basically the same data as you need for standard deviation. That is some period of returns, ideally monthly. Calculate the average, and in this case, rather than squaring deviations from the mean, you calculate the product of the deviations of 2 securities and sum those products. Again, in your own calculations, you will need to divide by n-1 rather than n, because you will be taking a sample rather than the whole population. Here's an example of how to calculate covariance and hence correlation. Take a note that here again it is a fictional example and it presumes that all available data is presented, hence divided by 3 rather than 2. You can also calculate a period return not only on one security, but rather as much as you would like. Here's an example of holding period return calculation for 2 securities, but you can expand expand this formula by adding together products of respective weights and returns of a given security in your portfolio. You can see here a simple example of two security portfolio holding period return calculation. When it comes to standard deviation, it is a little bit more complicated. Although you can calculate standard deviation of a portfolio with n securities, it would take a lot longer to do it by hand. As the matrix expands, you would need to include more and more calculations. Here is a formula of how to calculate two security portfolio standard deviation, but feel free to browse Google or ask your statistics lecturer on how to calculate standard deviation of a portfolio with more securities. The concept of calculating standard deviation of a portfolio is essentially to treat weights as an unknown and work out a formula in order to find needed weights to minimize the standard deviation or risk in your portfolio. It's a little bit more advanced topic, and I believe for those who are studying economics and all related subjects, you will do those calculations in quantitative techniques 2 and quantitative techniques 3. Here is an example of an equally weighted portfolio. And here is some thought about performed calculations, and take a note that portfolio standard deviation is lower than the average of two respective securities standard deviations. One last measure that you need to be aware of is beta, in financial world termed as sensitivity to the market and movement. It is often calculated in respect to a benchmark. For example, you have a portfolio of 5 securities from FTSE 100 index, and you want to see how sensitive your portfolio is relative to the market. If you get a beta of, say, 1.5, that means for a percent move in either direction in the market, your portfolio should move 1.5% in the same direction. And if beta is 0.5, then for every 1% market moves, your portfolio will move only 0.5%. Here is a formula of how to calculate beta, and it is relatively easy. You need the covariance of your portfolio or a stock and divide it by the variance of the portfolio or a stock. And as mentioned earlier, these are Excel formulas to calculate measures we talked about today. What you need is data that is returns over a given period, which you can download from investing.com or Yahoo Finance. You simply you filter the data, you sort it to get monthly returns on your chosen stock. You download the Excel file and you can perform these calculations in the very same file. Okay, so I believe that's it. And I'll stop sharing now the screen. Okay, where's Zoom? Yeah, we have.